Okay, and welcome to the module Introduction to Financial Modeling. So from the get-go, I want to take a moment and acknowledge the fact that financial modeling is a very deep and broad field of study. It is multi-channeled and multifaceted, and people can literally make a career out of it. So the goal here is to create a baseline of familiarity and prepare you in the event you may want to move down this path. And the formulas that we're going to cover represent the most common across all those various fields of study. Let's answer the question, what is financial modeling? Simply put, it's when you look at a company's historical past and try to make forecasts into its future. And yes, as we said, there is a wide variety of modeling types. And just to reiterate, we'll look at the most common functions across all those various fields of study, and that's going to include the following. We'll look at payment calculations, compound interest, present value, future value, net present value, internal rate of return, and a few others along the way. All right, time to get started. When you take out a loan, it goes without saying that you want to know how much the monthly payment is going to be. And Excel can help you with that by using something called the payment function. Let's take a look. In this case, we want to buy some new equipment, and we had to take out a loan for $150,000. The term of the loan is going to be for 10 years, and the interest rate is going to be 7%. So the question is, what is our monthly payment? So let's go up here and click on our FX icon, do a search for the payment, type in PMT, and overall, working with the payment function is pretty straightforward. Just a few quirky things which really aren't that bad. We'll start by clicking our rate, and then what we have to do is divide it by 12 to tell Excel it's an annual rate. Next, we'll click down where it says NPER. NPER is the number of payments. The only wrinkle here is we have to tell Excel the total amount of payments we're going to be making. If we break it down, we make 12 payments per year, and since it's a 10-year loan, we have to multiply 10 by 12 to get the total amount of payments. And with the NPER, we have a couple choices. We could type out 10 times 12, we could type out 120, or we could click the cell with our term and multiply that by 12, of which I'll do. So I'll click the cell here, multiply that by 12. And then for PV, let's go up and click on our loan amount. Click OK. Excel will work its magic. So it turns out we are going to owe approximately $1,700 per month for this loan. And right there is your payment function. Okay, next up is compound interest. So what exactly is compound interest? Simply put, with compound interest, you keep paying on the amount you owe, not just the base loan amount. Any interest that you owe gets calculated into the next payment. And the part that really stinks is there is no built-in function that Excel can offer us. We have to use a very specific formula and type it out longhand. So let's look at the formula first, then we'll plug in some numbers. You can see the formula right here on your screen. And as a side note, this formula is widely used in most business schools. So the formula goes like this. The amount you're going to owe is equal to the principal amount multiplied by 1 plus the rate raised to the nth power. Yeah, not fun. So let's see our example, and then we'll type out the formula. What we want to do is take out a loan of $100,000. Our interest rate is going to be 5%, and the term of the loan is going to be 10 years. Let's type out our formula to find out how much we're going to owe. Type equal, we'll click on our principal amount, multiply that, do an open parentheses, type 1 plus, click on our interest rate, close this parentheses, do a caret symbol to raise that to the N, which is the 10-year term. We'll click on that, press enter, and in 10 years, that is how much we're going to owe. And right there is your compound interest. Okay, let's continue on and start to explore the concept of the time value of money. In a very watered-down definition, the time value of money is this. As time progresses, money will be worth less in the future. So now that we have that under our belt, in this lesson, we'll take a look at 3 very common functions, which are present value, future value, and NPER. And we'll start off with future value. So what exactly is future value? Well, it tells you how much money you will have if you invest X amount over X years at a given interest rate. So for example, if we invest $100,000 today and we get 10% over 10 years, how much is that going to be worth in the future? Let's use the future value function to solve this. We'll go up, click on the FX icon, do a search for FV, and then from here, it's pretty much fill in the blanks with a slight twist. The rate is going to be this cell right here. The NPER is going to be our term, so we'll click on that cell. Now where it says PMT, what Excel wants to know is, are we going to be putting in any additional payments? In this case, we're going to type in 0 because we're not going to do any. And then for present value, or PV, since this is money out of our pocket, we have to put it in as a negative value. So we'll type a negative, then click on our amount, click OK, and right there we go. After 10 years, here's how much we can expect to have. Moving on, let's talk about present value. With present value, it tells you how much money you have to invest in today's dollars if you want to reach a particular financial goal in the future. By way of example, let's say we want to make $100,000. We can get 10% on our money, and the time frame we have to work with is 5 years. The question is, how much money do we have to put down today to reach that goal in the future? The present value function will show us that amount. Start by clicking our FX icon, do a search for PV, and now where it says rate, we'll click this cell right here. Where it says NPER, we'll click this cell right here. Now where it says PMT, or payment, what Excel wants to know is if we are going to be putting in any additional money. In this case, we're not, so we'll type a 0. And then where it says future value, we'll click right here because that's our goal. Click OK. And that is how much we have to put down if we want to reach that goal given these parameters. And right there is your present value. Moving right along, let's take a look at NPER. NPER stands for number of periods, and it can be used to tell you how long it will take to reach an investment goal or how long it will take you to pay off a loan. In this case, let's say we want to reach a particular goal. Taking a quick look at our data, what we want to do is invest $10,000. Our goal is $15,000. We can get 5% on our money, and we want to know how long it's going to take. So we'll go up and click on our FX icon, do a search for NPER, and now where it says rate, we'll click right here. Where it says PMT, or payment, we are not going to put in any more money, so we'll type a 0. For the PV, or present value, this is money out of our pocket, so we'll type a negative first, then click on the investment amount. And for FV, or future value, that's how much we want to get in the future. So we'll click this cell right here, then click OK. And right there is the NPER. Rough cutting the numbers, it looks like it will take 8 years to reach our objective. Okay, let's take some time and look at the NPV, or net present value. So from the get-go, please recognize I'm going to offer an overly simplified, arguably watered-down definition of NPV. Why? In real life, NPV can get very muddied, it can get very murky, so the goal here is just to boil it down into its purest essence. So before we get too immersed in NPV, it makes more sense if we ask, why do we want to use it in the first place? On a very fundamental level, with NPV, we want to know if we invest money that generates income over a given time frame at an expected rate of return, is it even worth it? The way we figure that out is we have to calculate the present value for the future value of all our cash flows using our expected rate of return. Put another way, we have to look at our expected total return in today's money to see if it's even worth it in the first place. Really what we're doing is we're going to convert future money into present day money for comparison purposes. And when it's all said and done, if the NPV is greater than 0, it might be worth doing it. Let's see an example to clarify this. Let's say we have $10,000 to invest. We can dedicate 5 years to it. And with this investment, we are expecting to get $3,500 a year in income at a discount rate of 10%. So the question is it even worth our while in the first place? This is where Excel's NPV function will come into play, because what it will do is figure out the present values for our time frame, add those numbers up, and tell us what this investment will be worth in 5 years. Let's get a little more granular here. When we ask Excel to calculate the NPV, it will look at our projected income for each year. It will then calculate the present value for those individual years, add them up, and then give us the total of all those present values. Put another way, it will figure out the present value for year 1, it will figure out the present value for year 2, it will figure out the present value for year 3, etc. add up all those results, and show them to us. So the net in net present value means the total of all the present values you asked Excel to calculate. In this case, it will be 5. Ugh, good grief, that's a headache in a suitcase. Let's get this done. So to calculate the NPV, let's go up and click the FX icon. Do a search for NPV. Where it says rate, we'll click on our discount rate. And where it says value 1, we'll select our estimated cash flows for those years. Click OK. And it looks like we get a result of roughly $13,000. So what Excel is telling us, based off all the numbers that we provided, is that the investment is worth $13,000 in today's money. But we're not done yet because we have not calculated the official NPV. To do that, we have to subtract out the initial investment of $10,000. So we'll do that. And it looks like the official NPV is roughly $3,000. So the whole point of calculating our NPV is to determine if the investment is even worth it in the first place. And the way we do that is to translate all of our future cash flows into today's equivalent. And once all of our calculations are done, the biggest question is the NPV greater than 0? If the NPV is greater than 0, it might be worth investing. If the NPV is less than 0, it's a bad investment and you don't want to do it. And mercifully, that will wrap up the NPV. Okay, let's switch gears and talk about IRR. IRR stands for internal rate of return. And before we get into things, just know that the IRR is closely related to the NPV, so make sure you understand the NPV before watching this segment. To get your mind around the IRR, it's best to start off by looking at an example. Let's say we can invest $10,000 and generate $3,500 a year over the next 5 years. And we don't know the rate of return. Rather, the only thing we know is what we're going to get, which is the cash flow. So we can use the IRR to figure out that rate of return. So we'll go up, click on our FX icon, do a search for IRR, and here it's very easy. All we have to do is just select the numbers, and we get this percentage. This is where the NPV comes into play. With this rate, it tells you the NPV is 0. You get nothing, you gain nothing, and you lose nothing. Here's how the IRR works on a conceptual level. The main question with the IRR is what makes the NPV 0. And the other thing to note is that the IRR is a variable, which leads to an even more obvious and logical question, which is why would you even bother to do this in the first place? The main idea backing this is that the IRR is ultimately used in making decisions. Going one step further, in business, you generally have the opportunity to invest in different things. So when you compare opportunities, the higher IRR is often the best bet. So by way of example, let's say here at the company, we're considering 2 new product lines. One works out to have an IRR of 22%. The other one works out to have an IRR of 25%. If we compare the two, it looks like the one with a 25% would be the better bet. So that would probably be the best one to invest in. And we'll draw the line right here because the IRR can get pretty intense, and we encourage you to research it further on your own. So let's wrap up this module on financial modeling by looking at a common function used in business, which is the aggregate function. In layman's terms, aggregate means you're going to do calculations on a bunch of numbers, which results in a single answer. Now, if we shift our focus to Excel's aggregate function, there's a lot the function can do, but we'll look at it from a very high level. The reason we say this is because when you start to use Excel's aggregate function, it allows you to get access or tap into 19 other functions or sub-functions, if you will. So you can kind of make the case it's like a 19 for 1. Yikes. So for those reasons alone, let's keep it very simple. Another big box office draw with the aggregate function is it allows you to ignore hidden rows, you can ignore errors in your cells, and you can also filter records, which is really cool. So let's see this in action. Here we have our customer sources. Here we have our sales. Also take note that we have an error in our data, and I'll turn the filter on for demo purposes. To get us started, let's try and take a standard average and see what we get. So we'll type out equal, average, open parentheses, select our range, and it should come back and yell at us because of the error message. There we go. That looks about right. And now let's take the aggregate function for a test drive. Believe it or not, it's actually easier to type out the function because Excel will walk you through step by step, prompting you along the way for the information it needs. Here we go. We'll type out equal aggregate, open parentheses. And the first thing Excel wants to know is what type of calculation we want to do. In this case, we'll choose average. And here we have a choice. We could either double click on the average or type the number 1 because it corresponds with the average calculation and type a comma. I'll choose to double click just because it's easier and follow that with a comma. Next, Excel is going to ask you what type of things you want to ignore. Now, clearly in real life, you'll need to take a moment and read this list. Here, we'll go with the option of 3 because choosing 3 will allow us to ignore hidden rows, error values, nested subtotals, and all that other fun stuff. Type a comma. And last thing we have to do is select our chunk of cells, of which we'll do. Then press enter, and oh my gosh, right there it is. And just for fun, let's do a little filtering so you can see that in action. All right, and that will do it for the overview of the aggregate function. As mentioned earlier, we recommend that you take the time to study the various combinations and permutations that you can do with the aggregate function. That said, that brings us to the conclusion of this module, and we'll see you next time.